What if I told you that during America's worst banking crisis, when 9,000 banks collapsed overnight, there was one place where not a single depositor lost a penny? Not because these people were wealthy, not because they had inside information, but because they understood something about money storage that banks desperately wanted to keep hidden. This system was so effective that deposits grew by 800% during the Great Depression, while traditional banks were hemorrhaging money and closing their doors forever. The banking industry lobbied for 50 years to destroy this system because it proved that banks weren't necessary for keeping money safe, and they finally succeeded in 1967. But here's what they don't want you to know. The modern equivalent of this system still exists today, hiding in plain sight on a government website that most people have never heard of. Today, I'm going to reveal the forgotten cash strategy that saved American families during the 1929 crisis and show you exactly how to implement it in 2024. The story begins in 1910, when Congress created something revolutionary, the United States Postal Savings System, allowing Americans to deposit money at any post office in the country. This wasn't just another bank. This was the United States government directly guaranteeing every deposit with the full faith and credit of the federal government itself. When the banking system collapsed in 1929, most Americans discovered that their life savings were trapped inside failed institutions that couldn't pay them back. But the postal savings depositors experienced something completely different. They walked into their local post office and withdrew their money exactly as they always had. Word spread quickly that while banks were failing everywhere, the postal savings system had never failed to honor a single withdrawal in its entire history. Between 1929 and 1934, deposits in the postal savings system exploded from $150 million to over $1 billion. This wasn't because the government was offering better interest rates. In fact, postal savings paid only 2% annually, deliberately kept low to avoid competing with commercial banks. People flooded into postal savings for one reason only: absolute security when everything else in the financial system was collapsing around them. The fundamental difference was structural. Commercial banks were profit-driven businesses that could gamble with depositor money and lose it all in speculative investments. The postal savings system had no shareholders to enrich, no risky investments to make, and no incentive to do anything except safely hold depositors' money. When commercial banks made bad bets on the stock market and real estate speculation, they lost their depositors' money. But postal savings had no exposure to these risks. This brings us to the critical insight that changed everything for the people who survived the Great Depression financially intact. They understood that the problem wasn't finding a safer bank. The problem was that they were using banks at all when a crisis threatened the entire banking system. When systemic risk threatens an entire industry, the solution isn't to find the best company in that industry, it's to exit the industry entirely. This is why the postal savings system worked so perfectly. It removed depositors from the banking system entirely and placed them directly with the federal government. There was no intermediary that could fail, no corporate decision-making that could go wrong, and no profit motive that could compromise the safety of deposits. The banking industry recognized this as an existential threat to their business model and began lobbying immediately to have the postal savings system eliminated. They argued that government competition in banking was unfair, that it crowded out private investment, and that it wasn't necessary once banking regulations were strengthened. After decades of political pressure and millions spent on lobbying, Congress finally abolished the postal savings system in 1967. But here's what the banks didn't anticipate. The underlying infrastructure they fought so hard to eliminate would be rebuilt in a different form decades later. Today, you can access the modern equivalent of the postal savings system through a website called Treasury Direct, operated by the United States Treasury Department. Treasury Direct allows any American citizen to purchase Treasury securities directly from the federal government, completely bypassing banks and brokerage firms. When you buy Treasury bills through Treasury Direct, you're lending money directly to the United States government, with no bank or broker in the transaction. This means there's no intermediary that can fail, no FDIC insurance needed because there's no bank to insure against, just you and the federal government directly. You can purchase 4-week Treasury bills that automatically roll over, maintaining liquidity while keeping your money completely outside the traditional banking system. When Silicon Valley Bank failed in March 2023 and panic spread through the banking sector, people with Treasury Direct accounts experienced nothing. No bank holiday can freeze a Treasury Direct account. No bank run can touch it, because it exists completely separate from the banking infrastructure. This structural separation is exactly what saved postal savings depositors during the 1920s and 30s when banks were failing by the thousands. But Treasury Direct is just one piece of building a truly resilient cash storage strategy based on the lessons learned from the Great Depression survivors. The complete strategy involves layering multiple independent systems that can't all fail simultaneously, each providing different types of protection and access. Layer 1 is your operating cash in an FDIC-insured commercial bank, necessary for daily transactions but kept under the insurance threshold. Layer 2 is secondary cash reserves at a credit union insured by the NCUA, which operates under a completely different regulatory framework than commercial banks. Credit unions are owned by their members, not shareholders, which means they operate more like the mutual savings banks that survived the Great Depression. Layer 3 is Treasury Direct for longer-term cash reserves that need maximum security but don't require immediate daily access for transactions. Layer 4 is physical cash in small denominations held outside the banking system, providing a transaction bridge during payment system disruptions. This isn't survivalist paranoia. It's insurance architecture based on what actually happened when the American financial system collapsed in the 1920s and 30s. The people who used this layered approach weren't trying to maximize returns, they were trying to ensure that no single point of failure could wipe out their savings. When Franklin Roosevelt declared a national bank holiday in March 1933, every bank in America was forced to close for 8 days. People who were completely dependent on bank accounts couldn't access their money for over a week. But postal savings depositors could still conduct business normally. A bank holiday is not an ancient impossibility. The legal mechanisms that would trigger one exist in 2024, just as they did in 1933. A severe cyber attack on payment infrastructure, rapid contagion from a major bank failure, or regulatory intervention to slow withdrawal velocity could trigger similar measures. The difference between surviving these scenarios and being caught unprepared is making structural changes before the crisis, not scrambling during it. Bank failures don't happen overnight the way people imagine. They happen in slow motion over months before the sudden stop that gets all the attention. The banks that failed in 1930 had been quietly reducing their reserves and taking increasing risks for months before they collapsed. The warning signs were visible to anyone who knew what to look for, but most depositors never examined their bank's financial health until it was too late. Today, you can access the same information through FDIC quarterly call reports that show capital ratios, loan delinquency rates, and risk concentrations for every bank. Most people will never read these reports, but for those who do, early warning systems for bank instability are available, just as they were in the 1920s. Understanding this history reveals a fundamental truth about money that most financial education deliberately ignores or glosses over completely. Your bank deposit is your asset, but it's also the bank's liability, and when a bank cannot meet its liabilities, your asset disappears. This isn't theoretical risk. This is exactly what happened to millions of depositors who lost their life savings when banks failed in the early 1930s. When you hold Treasury securities directly through Treasury Direct, you have a claim against the United States federal government, not against a private intermediary. That structural difference is the entire foundation of financial resilience and explains why postal savings worked when everything else failed. The most dangerous financial illusion isn't that banks are risky. It's that because your account balance looks normal every morning, the underlying structure must be fine. Roman citizens probably checked their denarius coins every morning too, right up until the currency system collapsed and the coins became worthless metal. The 1929 strategy wasn't complicated. It required no special access,
no sophisticated knowledge, and no connections to wealthy insiders. It simply required understanding one structural truth about money and acting on that knowledge before the crisis, not during it. By the time lines formed outside failing banks in 1930, it was too late to implement protective measures because deposits were already frozen. The postal savings system window remained open throughout the entire crisis because it operated independently of the commercial banking system that was failing. Today's equivalent is Treasury Direct, which will remain accessible even if the banking system experiences severe stress because it operates completely independently. The question worth considering isn't whether your money is currently safe. It's whether your money is positioned to remain safe if the rules change suddenly. Financial crises don't announce themselves in advance. They reveal themselves after the protective mechanisms people trusted have already begun to fail. The survivors of 1929 weren't people who predicted the specific timing of the crash. They were people who had already positioned themselves structurally. They understood that when systemic risk threatens an entire industry, you don't find the best company in that industry, you exit the industry entirely. This principle applies just as powerfully today as it did 95 years ago, which is why the banking industry worked so hard to eliminate postal savings. They recognized that a successful government alternative to banking proved that banks weren't necessary for safe money storage, which threatened their entire business model. The fact that Treasury Direct exists today proves that the underlying infrastructure for safe, government-backed cash storage never actually disappeared.
It was simply repackaged in a form that was less obviously competitive with commercial banking, but functionally identical to what saved people in 1929. The people who understand this history and act on it before the next crisis will find themselves in the same advantageous position as the postal savings depositors of the 1930s. If this analysis of forgotten financial history has been valuable to you, subscribe to this channel because every video here follows the same approach. We examine what actually happened when financial systems failed throughout history and extract practical strategies that still work today. The most important financial knowledge is often the knowledge that powerful institutions have the strongest incentive to keep hidden from public awareness. Understanding the real history of money reveals opportunities and protections that conventional financial education never mentions because it threatens established business models. The 1929 strategy worked because it was based on structural reality, not market predictions, and structural reality hasn't changed as much as people think. Your financial safety ultimately depends not on predicting the future, but on understanding how money systems actually work when they're